Hey, this is Ken Finnan at Capital Advantage Tutoring, and this is going to be one people have been asking about for a while, and I keep not doing it. It's just kind of boring. Okay, so it's like numbers and shit like that, and I'm just not a number guy. So what you're gonna have to do is take a seat and let's get into it. Try not to fall asleep. Okay, let's go. So there are a lot of ways to analyze a stock or to decide whether it's good or bad or not, and the two ways that we're going to talk about in the exam are fundamental versus technical. Now, this would work for the Series 7, the 65, 66. This is all good stuff. Again, not digging deep like you would for a CFA or bigger exam like that, but this is just to understand the high level stuff so you can understand it. So this fundamental, which is the no fund, we're looking at balance sheets, income statements, cash flow, current ratio, shareholders' equity, retained earnings, the actual company, stuff like that, quantitative, qualitative, all that stuff. And then we have this hot mess of technical trading, support, resistance, trends, part, momentum, stuff like that. We're going to get into all of it, but not enough to be a trader because the other traders that I have will kill me if I make it that simple. We got this. Hey, just a quick little break to remind you to like and subscribe. Let's look at the balance sheet and try to see if we can figure some shit out. So remember, fundamentals looking at the balance sheet, the assets and the liabilities. So here's a sample balance sheet from a sample company, doesn't matter. So let's look, the left side is the assets, the right side is the liabilities, and I can't fucking speak for shit. So let's break this down a little bit. Let's go through this stuff. So over here, the current assets. These are all things that we either have right now or we're going to get them within a year. Cash and cash equivalents, short-term investments like money markets and stuff like that. Accounts receivable, that's what we're getting within a year, okay? Inventory is always there. Any supplies we have that we may use, and then any prepaid expenses. Like if we pay like the cable bill up front, or like we pay ahead, or we pay a rent ahead of time because we paid it ahead of time and we're waiting to use it. So those are prepaid expenses. Those are considered assets. Those are current assets, okay? And then we have investments. Okay, so now on the current liability side, these are things that we owe in the next year or so, short-term loans. So let's think of it this way: if I have a short-term bond or a short-term loan, I owe money in a very short-term period. But let's say I have a big-ass bond and I owe it over 20 years. The interest that we owe now, this year, is a current liability. That's why it's saying current portion of long-term debt. That's a short-term debt liability because it's the interest you owe this year, not for the whole bond, just this year's portion. Any accounts payable, stuff we owe within the next year. Any kind of accrued compensation. So I say I have 20 workers working for me, and you know how you get paid every 2 weeks, right? So if you get paid every 2 weeks, as you're working, you're accruing earnings. That money goes onto my balance sheet because I owe that money to you. It's not mine. So I have to deduct it. So that's, remember, this is a snapshot. So at this time, right now, when we do the balance sheet, how much of accrued compensation and benefits do I owe to people? And the income taxes that are payable that I know I owe. Other accrued liabilities, deferred revenues, like, okay, so like deferred revenue is like if somebody pays me up front to tutor for them, like a month ahead of time. I've gotten the money, but I owe the service. So that's also a current liability. I will owe it very soon. Okay, that's the current assets and current liabilities. Now, if you want to get my working capital, I'm going to do total current assets, which is the 89 minus the 61. So in this case, whatever 89 minus 61 is my working capital. Hope that makes sense. Now let's go to more fixed assets. Okay, fixed assets are like properties, plants, land, buildings, equipment, any of that stuff. Those are all considered long-term assets. And then the intangible assets like goodwill. Goodwill is like our reputation. It's intangible stuff, our reputation, what customers think of us. Anything intangible that isn't really touchable, but they can actually quantify the value of it. Like I always think of it this way, like it or not, when Trump said he was worth $8 billion, well, you look at it, he assumes his name was worth $4. This is before it started, right? So his actual company was worth $4 billion, but he said he was worth 8 because there's $4 billion of goodwill because he used to be able to rent his name out and make money. So that's goodwill. Wrong or right, that's the best way to think of goodwill. It's not a touchable thing. When we look at total assets, it's a current plus the fixed. That's why in the bottom, if you stop this and take a look, you can add them all up and come up with 770. And remember, a balance sheet needs to balance, okay? So it all needs to balance. So we have total assets minus total liabilities. That's going to be our shareholders' equity. So the 770 minus the 481 is going to be our shareholders' equity or net worth. Now we have other things. Okay, so there's a thing called the footnote. Footnotes you add to the balance sheet to make it, what's the best way to explain it? It's to explain shit in the balance sheet. That's what you put it. Like if you put something on here and you need some context, you place a footnote in the balance sheet. So I just press pause to do the math. I did total assets minus total liabilities. That's my shareholders' equity. That's 289. Now let's talk about a couple things. Common stock. So let's talk about retained earnings and common stock. Okay. So if we earn money and we keep out whatever we don't pay in dividends is retained earnings, and it's on the balance sheet as retained earnings. Okay. So whatever we don't pay in dividends is retained earnings. If we have $1 million and we pay out 400 grand in dividends, that leaves us retained earnings. Okay. That leaves us retained earnings. Okay. This should give you an idea. I'm trying to talk slow. It's just in my fucking DNA. It is speed talk. I apologize. Just put everything on 0.75. So again, working capital is the current assets minus current liabilities. Now, if you want to know current ratio, it's current assets divided by current liabilities. That's a liquidity measure. If you want to know the quick ratio, you do the current assets minus the inventory divided by current liabilities. And there are other ones, but they're not really on the exam that much. If you want shareholders' equity, it's going to be total assets of 770 minus a 481. One last thing I want to talk about before I totally leave the whole balance sheet. Outstanding shares. Remember this. We don't care about the authorized. If they give you authorized, don't really give a shit. Authorized shares is just a fucking number that they put out there to say, hey, this is how money we're allowed to issue. The issued shares is what matters. So you issue 1 million shares, and if they say you have treasury stock of 50,000, you leave 950 outstanding. Remember, issued shares minus treasury equals outstanding. And remember, once stock has been issued and it's bought back the treasury stock, that stock has still been issued. It's just issued, then bought back. And why do people do that? Why do companies buy back stock? Well, they have a lot of rules on it, but their job, they want to keep it stable, keep it at a price. They can't really manipulate it, but it's what it is. They maybe want to they want to keep their power. They want to lower the dividends they want to pay, and they have a lot of rules. So if it's corporate buyback under 10b-18, don't need to know the number, but a corporate buyback, they have a lot of rules. The company's buying back their shares. They can't buy on the opening. They can't buy in the last 10 or 30 minutes of the day, depending how liquid. If it's on the exchange, you can't buy in the last 10 minutes of the day. If it's over the counter, you can't buy in the last 30 minutes of the day. You can't buy more than 25% of the average daily trading volume unless you do a print. Once a week, you can do a print, and that doesn't count toward your volume. You also can't buy in a plus tick. What the hell is a plus tick? That means you have to buy at the last sale, or basically this way, at the last sale or the highest independent bid. You can't push the price up. So if the stock's trading at 40, you can buy it at 40 all day long. But if it trades at 41, then you can do that. Or if somebody else is bidding, say the last sale's 40 and somebody's bidding 40.50, you can buy at 40.50 because someone else is there. So you can buy at the greater of the last sale or the highest independent bid. Independent means someone that you're not affiliated with. So those are all the rules. So why do they do that? Well, it's called the safe harbor guideline. It's actually, I use the word rules, but they're guidelines, and no company will ever violate them, because if you follow those safe harbor rules, not on the opening, not really near the close, volume restrictions, price restrictions, if you follow them, you won't be sued for manipulating the price. So that's why they follow them. I've had a time where the guy called up and said, you need to buy them. And I'm like, it's 355. We can't do that. And I said, we can do it, but I need permission from the company to do that. And he goes, I got permission from the company. The company needs to, because they need to do it by the end of the quarter, whatever it was. And we did it. Nothing happened. We tried to follow the other rules, make sure we didn't buy above the last sale or anything, but we did violate the guidelines. Nothing happened because it's not a violation. It's just you open yourself up to be sued for manipulation. Okay. Little rant on unrelated stuff, but it could be on the test. Okay. So let's look at the income statement as opposed to the balance sheet. Okay. The balance sheet is assets. The income statement is the money going in and out. Look at sales, profit margin, cost of the goods you sold, the expenses, your operating income, all your interest, revenue, and expenses, income before tax. It's all, and it has a net income. The income statement is about the money flow going in and out. This test will not go heavy into ripping apart, figuring out gross margin and stuff like that. Kaplan, SDC, Past Perfect, absolutely will ask you. The actual exam won't make you do it. It's mostly about finding out whether it's on the income statement or the balance sheet. Take a look at this picture, maybe pause it, look at it, and let's rip through it, okay? So sales, it's just the sales, 50 million in sales. Then the cost of goods, whether it's materials, labor, any kind of overhead, which is rent and all that shit, brings us down to $25 million of gross margin. Now, the expenses of selling it, we have to pay the salespeople, ads, stuff like that. That reduces it down. So look, our actual operating income is only $5 million. From sales of $50 million, our income is only $5 million. Now, remember, some of the selling expenses are paying people, and administrative is paying people. So it's not like we're not making money. It's just the company has less profits officially because they're paying out expenses. That's what this is about. This is about the money flow in and out and all that other stuff. And if you look, the 150 is kind of crazy. It's like boom, boom, boom. Okay. I don't know why they did that. But the whole point is you want to make sure that this is the income statement. You know what it looks like. You don't have to rip it apart. You have to know that this is the stuff on the income statement and the other stuff, meaning the assets and liabilities, is on the balance sheet. That's really the key to this thing. Couple of things you will have to know how to do. One of the ratios is debt to equity. You don't need to know how to do it. You need to know what it is. Debt to equity is the amount of debt we have, not the market value of the debt, the debt divided by the shareholder's equity. So it's all the debt versus the shareholder equity. We may have 37%, a dollar, more than 100%, whatever it is. A 1-to-1 debt equity ratio means we have the same amount of debt as we have equity. The lower we have, the stronger we are. The higher we have, the more leveraged we are. And depending on the industry, some like utilities are very highly leveraged, where some industries are very low leverage or not, they don't borrow a lot. We have to know PE ratio. What the hell is that? PE ratio is price over earnings, okay? So it's your market price divided by earnings. I think we know how to do that, right? So if I show you, here we are. So the common stock of a company is $84 per share. The PE ratio, the PE ratio was 14-to-1. Earnings were $6. Dividends were $3. After a 5-for-1 split, what's the new PE? Okay, so they gave you the PE ratio. They want to figure out the old one, but we're going to do it anyway. So if you do 84, the market price of the stock, divided by the earnings, that's earnings per share, 84 divided by 6 equals 14-to-1. Awesome. Now, let's say there's a stock split. The stock split will affect the price. So that price will now go to, I think it's 16.8. I'm going to do the math in my head while we're talking. The handy-dandy calculator, 84 divided by 5. That gives me 16.8. So my new market price is going to be 16.8. And then the earnings do go down because when you do a stock split, you have, remember, if you have an earnings per share of 6, and now you do a 5-for-1 stock split, you have the same earnings, but lots more stock. So you're going to do, so it goes down. So 6 divided by 5 equals 1.2. So now we have a earnings per share of 1.2. And how do we do PE ratio? We're going to do 16.8 divided by 1.2. Voila, that's still 14-to-1. So remember this. A stock split does not affect PE ratio. Boom! Just remember that, but I made you do the math anyway. A stock split does not affect PE ratio. Because so what happens is both the stock and the earnings per share go down at the same rate, the same ratio. So there's 84 and 6 is 14-to-1, but then they go to 16, 8.8 and 1.2, still 14-to-1. Hope that helps a little bit. Book value per share is really the liquidating value of the company. Basically, all the total assets minus like intangibles and goodwill and all that shit, the actual hard assets divided by the number of shares. So the total assets minus all the intangible goodwill and all that stuff divided by the number of outstanding shares. That's book value. And price to book, like PE ratio, is market price divided by book value. Okay. Remember, if you have a high price to book or a high PE ratio, they'll say the word high, is a growth stock. If it's low, it's a value stock. Earnings per share shouldn't be that hard, right? Earnings per share. Remember, we're dumbasses. They actually put what it is in the name of it. You take the earnings divided by the number of outstanding shares. Earnings divided by outstanding shares. That's all it is. Earnings divided by outstanding shares. I said that 3 times. I'm going to say it again. Now, if you say earnings, we're going to go, okay, but what if they do the whole preferred thing? Okay, so you do earnings minus the preferred divided by the earnings per share. Earnings minus the preferred, what they pay out in dividends, because remember, earnings per share is actually earnings available to common per share. So earnings minus what you pay in dividends to the preferred divided by the outstanding shares. Again, I can do the math on it, but it's most of the time you won't do it. It's a very small part of this shit's a very small part of the test, but people ask about it and they worry about it. So again, earnings per share is earnings minus the preferred dividend, what they pay maybe, divided by the outstanding shares. What if they say, oh, what's my dividend payout ratio? Okay, my dividend payout ratio is basically what we pay in dividends divided by earnings per share. Think about it. It's how much we're paying out versus what we earned. I could put the numbers up, but I want you to think about this, okay? I could just share the screen and do that, but I'm going to be a dick and I'm not going to do that. So dividend payout ratio is how much we pay in dividends divided by what we earn, which is earnings per share. Again, a question I might have gotten on there. It was really, what do you need for the dividend payout ratio? Earnings per share. It's the amount of dividends we pay divided by the earnings per share. Have you ever gotten a current yield question? Let's try to do one. Let's hold on. Okay, so here is a current yield question for stock, not bonds, right? It's what I'm earning versus it's what I'm earning divided by what I paid. I earned $1.30 quarterly dividend. Quarterly dividend. So I have to multiply that times 4. 1.3 times 4 equals 5.2. And then I divide it by the current price, which is 95.06. 95.06. That gives me a current yield of 5. You can't see it because of the black screen, but it's 5.47. That's the current yield of common stock. Again, current yield on stock is the annual dividend divided by the market price. As one of my friends said, AMP, annual market price, annual divided by market price. Okay, so one of the questions you might get on the test, maybe not, maybe you will. So like my strong belief convictions there. So here's your assets of $1 million and you have liabilities of 200 grand. That gives your shareholders equity of 800,000. So let's say the company declares a $200,000 dividend. Remember, they all have to be declared. All dividends have to be declared. So they declare a $200,000 dividend. And as I said before, once they declared it's a liability, so we're going to go, our liabilities now go up by 200,000. So we go up to 400,000. Now, in this case, our new shareholders' equity, because it's going to change, is now going to be 600,000. Assets didn't change, but their liabilities went up. Now let's go to the next time. Now we pay so the next step is we pay the dividend. That's on the payable day. We pay the dividend. I can't spell. There we go. Pay the dividend. We're going to pay a $200,000 dividend. So since we're paying it out of assets, cash, our assets go down to 800 grand. But then we had liabilities of 400 grand, but we don't owe the 200 anymore. So our liabilities go down to 200,000. And now we're still at 600 grand. So what's interesting is if you declare a dividend, your shareholders' equity drops because the liabilities go up. If you then pay the dividend, both the assets and the liabilities go down at the same amount. So then your shareholders' equity doesn't change. Okay, so a new one. So we have current assets of $1 million, current liabilities of 200 grand, working capital of 800 grand, right? So it's current assets minus current liabilities, working capital. Now, if I did the current ratio here, it'd be $1 million divided by 200,000. So that'd be 5 to 1. That'd be my current ratio. Okay, so now let's talk about, let's say, what if we buy equipment? Like, so what if we buy a tractor, a $50,000 tractor for, I don't know, 50 grand, right? We buy for 50 grand. I'm an idiot. So we buy $50,000 tractor for 50 grand. Good. We didn't overpay for it. Unlike now with the cars, I'd have to do a market, what do they call it? A market adjustment of 20 grand or something, right? But let's say I pay $50,000 for a tractore. I guess it's an Italian tractor. We're going to come back. Now, so we have a $50,000 tractor we buy. Now we're going to use current assets for that, which is cash. So we pay cash for this. So this is going to go to 950 grand. Because this is a fixed asset, it doesn't help my current asset. So I do drop. my total assets won't change because the 50,000 I pay for the tractor will be replaced by the value of the tractor. So my actual working capital will go down because I don't know anymore. So now my new working capital is going to be 750 grand. That makes sense? Good. Okay, now let's get out of here. Back away. Now let's say we issue a bond. We'll say we issue just say $20,000 bond. What the heck, right? Over a 20-year product. We issued $20,000 bond. We received 20 grand in cash. So now our current assets, because cash is one of them, goes up and now at 1,020,000. Hope I do this right. Oh, should have done a bigger number. And then my current liabilities. Remember, my current liabilities don't change other than the interest I have to pay, but I'm not going to do that math here. But the bond is a long-term liability, so that doesn't bother me. So my current liabilities is still 200 grand. And then I have to do this fucking math. So it's going to be, do I really have to do this math? 820, right? 820 grand. Got lucky there. Okay. So my new working capital goes up. So issuing a bond actually helps my working capital because the money, the liability is a long-term liability, which doesn't go on my current liabilities thing. Hopefully that helps. Okay. So what are some of the forms we look at? The balance sheet. So now let's go into this. So remember, think of the balance sheet we just talked about as a snapshot right now of what's going on. It can change a day later, but right now that's the snapshot. What are some of the reports issuers will issue, publish, whatever you want to call it? So you can see that we have 10 Qs, which are quarterly, Q for quarterly. We have a first quarter, second quarter, third quarter, like 1 potato, 2 potato, 3 potato, 4. So the fourth quarter 10Q is actually wrapped into the 10K. 10K is the annual. Now the 10K is the one that is audited and signed by the CFO and audited by like a Deloitte and Touche, some KPMG, some auditing firm. That's the audited. Okay. Then if there's anything that happens like material that's in between the Qs, they're going to do an 8K. Now we've done the fundamental no fun way. Now we're going to do the hot mess of technical trading. Now, if you look, go this way, boom, I was pointing the wrong way. This is a technical chart, which we'll get into a little bit. But let's talk about what technical trading is. Technical trading is when they look at support, resistance, momentum, um, moving averages, trend lines, stuff like that. They're not actually looking at the actual company like we just did on the balance sheet. They're looking at the actual trading of the stock, volume, stuff like that. Like they're looking for trends in the trading, not the actual company. And that's what we have here because I keep running the wrong way. So this way. Now, so here we are. We have support and resistance. This is technical trading. We're looking at patterns and trends more than anything else. Okay. So again, with technical trading, we're looking more about trends and patterns, not the stock. We don't care what the stock is. I have no name on this. It doesn't matter. So look down here. We're going up a little bit and then down. We're bouncing off support because when it gets support, people see that and go, oh, it's at the support level. It's going to go up. So let's buy it. And then forces it up, sort of a self-fulfilling prophecy. Then when it gets up to the resistance point, we go, oh, it's at resistance. We think it's going to go down again. So we'll start selling it and that'll force it to go down. And then we have a little trading in here, stuff like that. Now look, it bounces off resistance again, goes down to support. Now look what this is. It went through the resistance. So that's called a breakout. And once something goes through the resistance, you think it's going to keep going. And this is sort of does. It does a little profit taking down and then goes up to the next resistance, starts a new range. So that's what happens. When a stock goes out, breaks out of its range, it'll usually create a new range. So resistance is kind of like it's going to have downward pressure when it gets on there, and support is when it's going to have upward pressure. But once it breaks out, there's enough buying pressure to break through this, then we have a new support. And that's what this becomes. So it goes up, it breaks out. So now normally, understand something. You would not want to buy the stock there because you still think it may turn around on you. So you'd probably want to put a buy stop just above 60 in this case, 60 and a half or something like that. So you don't want to buy it till it breaks through. So you would put a buy stop right around 61. So they go, look, I don't want to buy it till it gets up above 61. And then I want to buy it because I think it's going to keep going. Yeah, it looks like you'd rather buy stock at 58, but you can't tell the future. So you don't know that it's going to break through. So all you know is that if it gets to 60 again, you think it's going to go back down. So you don't want to buy it at 58. I might have said 68 before. You don't want to buy it at 58 because you don't know. It's more likely going to turn in your face. But if you buy it here, it's already through, so it's more likely to go up. And the same thing on the downside. Say it was here down at the 51 level, you would not want to sell it here. You'd want to buy it there because you think it's going to go up. But if it happens to break through, you'd rather sell it there when it's already broken through and it may create a new range down here with the new support and resistance level. So you would place a sell stop below the support so that you wouldn't sell it till it got through the support. So again, with this stuff, you can use buy stops and sell stops not as a protection, but as to get into your shit. So you could say, I'll place a buy stop above. That kind of works with the slobs over bliss. Buy stops above the resistance, or place a sell stop below support. Because remember, it's not real numbers, it's just theories, what we think is going to happen. And it's just trends. Now, a lot of times what you'll see too is like a moving average. I'm going to go back to my other chart on this one. Okay. Okay, so let's look at this one. Okay. So if we look at this, we get white, make sure we're white, and we got this going on. Okay. So now if you look, a stock is trading down. So what they do is you look for a trend. Okay, it's trading down here. Maybe I use black on this. So you see that it's up here, but then the next, you're looking for a trend. Now you don't have to recognize it, but understand this is how people are trading. They look for a trend. It's trending down, and then okay, now it's starting to trend up. And that's what you're looking for. Oh, the lows are higher and higher. Here, the highs are lower and lower. So that's a trend. Here, the stock goes down and then up and then down and then up. But each successive low is a little bit higher than the one before. So we have a trend. And then over here, we go back to this. It's starting to trend down again because each high is a little lower than the next one. So we have a trend down. That's another thing technical traders look for. They look for trends and patterns and averages and stuff like that to make a decision. So if you saw this trend, maybe you go, okay, maybe I'll buy it here. And then maybe you take the ride up to wherever it's going. And then, oh, wow, the trend's starting to drop. Maybe I'll get out when it pops up to the high one. Again, that's not your job to figure out for this exam, but that is what they're looking at. Okay. So we're going to look at other things like trading momentum. If you see a lot of trading or not a lot of trading, or we see some other, like there's another thing called short interest theory, right? So short interest theory, if you remember GameStop. So GameStop from early 2021, I guess it was. Every month, or really twice a month, FINRA will publish what percentage of a stock is short. I want to say held short, but it's not sold short. And what happens is if you see a really high short interest, like a very high percentage of people who are short the stock, it's actually it's actually a bullish thing. Why? Because if there's so many people short, what we have to buy it back at some point, right? Because if you buy stock, you can hold it for fucking ever and nobody cares. But if you short stock, you eventually have to give the shares back and buy them. So if there's a lot of people short, that means there's going to be a lot of people buying it first. So it's a very bullish indicator. The very high short interest is bullish indicator. And that's what happened with GameStop. Instead of being like 10 or 15% of the outstanding was short, 136% of the shares were short, which means more shares were short than actually were outstanding. So then all the Wall Street bettors and the apes started buying the shit out of it, forcing the hedge funds and all that to cover their shorts, panic buying, but knocked it up to $500. It really could have gone to any price. It held at 500 because I think people just weren't willing to go that high. I think on as high as 600 or 700, but that's a short squeeze where they're buying it to make the shorts buy their shares back at a loss and push it up. But that happens with short interest. You have two more. See, short interest is a contra indicator. So you have two more of them. The put call ratio, it's the amount of puts versus calls. Okay. Amount of open puts, amount of open calls. If you see a lot more puts than calls, you think it'd be bearish. It's actually bullish. Okay. The other one is odd lot theory. Odd lot theory is the fact that retail people are fucking idiots. That's what we think they are. They're last of the game. They come in at the end. They come out. They come in too late and they go out too early, or they come out too early, whatever it is. So they're always wrong. So what we look for is a lot of odd lot buying and selling. Odd lot is anything under 100 shares, which is what retail people do. So if we see a lot of odd lot buying, we're going to short the market. If we see a lot of odd lot selling, we're going to buy the market because we always figure they're late to the game, and why not just go against them? And it's actually a very valid strategy. Then we have the advanced decline ratio, which is the amount of stocks at a given time that are up versus down. Not how much, just up versus down. So it gives you what they call the breadth of the market, how wide or how powerful the up or down is. Like you can see a lot of stocks are up or a lot of stocks are down. And you go, okay, well, the market's up 10%, but it's really a mix of green and red, like buyers and like up and down. So it's not super strong. But if you see the market's up and it's all green, let me see if I can show you. Okay, so here's the S&P 500 heat map, right? So you look at it, it's all red. The red or anything that's down, whether it's a penny or a lot, and the green is what's up on the day. So if you look in this, the market's down 0.7%. I don't know when this was. It doesn't matter. But it's really a strong sell. Like a lot of stocks are down. And that means that it's probably a strong sell and there's a lot of things going on. That gives you an idea that it's a full-on sell. Now, let's just show you a different one. So let's look at this one. This is up 0.5%, okay? So the other one was down 0.74%. And then this, it was almost all red. Here, it's up 4.4%, and it's half green, half red, which means half of them are up and half of them are down for the day so far. But what this may show you is that it's not across the board full-on bullish day, right? So maybe it's just that a few of the greens are up a lot more than the reds are down. So it gives you an idea of how strong or how deep the market is. It's called the breadth of the market. And that's another thing that the technical traders use. They say if I see a lot of red, maybe it's in their mind they should be buying. They see a lot of green, maybe they should be selling, or a mix, maybe they stay away from it. It's all based on what the technical trader believes. But again, they're not looking at the actual specific stock. They're looking at overall trends and patterns and stuff like that. Okay, so now we're going to talk about a couple of patterns you may have to recognize or at least understand. So let's talk about, let's say it goes up a little bit, then down, then up a lot, then down, then up a little bit, then down. So that's a head and shoulders, right? So we can see the shoulder, and the head. So this is actually a bearish position, head and shoulders top, and it's actually called a reversal of an uptrend. This is the uptrend, and this is the reversal. This thing right here is like usually what happens is people are shorting it. It goes down. They're going to take their profits. It bops a little bit. Then it goes down. We call this a dead cat bounce because if you throw a cat off a building, it bounces once before it dies. So it's going to go, we think it's going to go up a little bit and then down. That's a head and shoulders top. Obviously, the other one would be this. This one, I'm always screw up. So that's a head and shoulders bottom. There's a shoulder, there's a head. So this is bullish or what they call a reversal of a downtrend. This is the downtrend. This is the reversal. That's a bullish thing. So then the other one you can learn is a saucer. This is a regular saucer. It looks like a saucer. Once we get to this point, it's bullish, but how the hell would you know it's going to go up? So it's just the thing we learn. And then the other one is an inverted saucer, which is actually a bearish thing. Nothing crazy. So there's a thing called efficient market theory where we believe that the market is efficient, that the price is the price. So there's inside, we have random walk theory, which basically means technical trader doesn't work. This shit doesn't mean anything. And you just throw darts at a dartboard, pick a stock. Like they did in the 90s, and I think they still did it. They used to use the Wall Street Journal and either throw stocks at a dartboard and they say dartboards versus the analysts, or have monkeys or chimpanzees pick stocks versus the analysts. And it wasn't always like, oh my God, the analysts always won. Sometimes the dartboard won, sometimes the monkeys won, sometimes the analysts won. So that kind of feeds into that you can't really beat the market. Anyway, that's fundamental versus technical. Hopefully I did a little explanation. Don't sweat it. It's not going to be crazy big on the test, but I get a shitload of questions about it. If you like what I'm doing, please check me out on Tuesday and Thursday nights on YouTube. I'm just doing a little cute Q&A every Tuesday and Thursday night. Not looking for a lot of people. I like having it where it is. I know who I'm talking to and stuff like that. But if you have questions, come on. If you don't have a question, don't worry about it. And I don't run it again. So if you miss it, you miss it. It's not a big deal. There's another one a couple of days later. Okay, everyone, have a great night, and I'll talk to you later.